Guten Morgen, mein Herren, or evening. Welcome back to Strongman Personal Finance. I just got paid to make this video. And if you pay me $40, see the pinned comment, I'll make a dedicated video and talk about whatever topic you want. In today's live stream, and I'm tired, but I'm still going to do it because I got paid for this. We're going to do a financial analysis of Clover Health. This video is going to be a minimum of 20 minutes long, but it's not going to be an hour long. I was given very specific instructions for this video from Mr. Anonymous. I should reveal your name. I'm just kidding. So let's go ahead and analyze Clover Health. Now, I've heard of this stock before, right? I believe this used to be a clown stock. Well, it probably still is a clown stock, but we'll see. But I remember people talking about how CLOV was going to 10x my Hinhex or go to the moon or MOAS or whatever. And we can clearly see that this stock started trading on the public markets, right when the pandemic started, June 15th, 2020. And ever since then, it has massively collapsed. Now, let's do the overview, and then we'll zero down into the recent results, because they actually just had earnings released today, which is fortuitous. Very, very fortuitous. I had no idea that happened. So what is Clover Health? It's an American healthcare company founded in 2014 that was publicly listed in 2020 during the clown market. The company provides Medicare Advantage insurance plans and operates as a direct contracting entity with the government. The company manages care for Medicare beneficiaries in 11 states and started publicly trading on January 8th, 2021. Okay, I guess that's when is it a SPAC? Whatever. So that's basically, it's a medical insurance company. It provides healthcare for old people, that are old and they just sit around and I don't know what they do. Okay. So if we go back, we can clearly see this is a healthcare company and it's all about the insurance industry. Now, the way the insurance industry works, and I'm no expert in the insurance industry, okay, but here's my general understanding. Insurance companies want to make a bunch of premium revenue and not spend a lot of money on claims. Okay, that's basically insurance. You want to take as much money in as possible, and you want to spend as much money. And they probably have a lot of cash sitting on the books to pay claims that come up out of nowhere. Okay, so let's do the overview of the company. I like to look at revenue. Has revenue grown massively? 100% it has. Their quarterly revenue has absolutely exploded. Now, in the clown market in early 2020, their revenue was basically flat. But their revenue has now been growing pretty significantly every quarter. It's like these massive jumps. I wonder if that's because of acquisitions. We'll see. But we can see a clear trend of revenue just like flat, spike, flat, spike. That's what she said. Okay. Gross profit. Let's look at the gross profit. Their gross margin has been negative. Oh, sorry, that's operating margin. I'm smoking crack here. Sorry. Their gross margin is barely break even. Okay. They have basically almost no profit at the top of the income statement. We'll drill down in a second. Operating margin is obviously negative, and profit margin is obviously negative. So it looks like the only time this company turned a profit was in the second and third quarter of 2020, and that could have been some kind of accounting adjustment. But overall, this is a unprofitable company that probably has never made money realistically since it's been publicly traded. Free cash flow, negative. Okay. We will look at their balance sheet on the actual 10K. And there's actually something that really bothers me. We'll talk about it in a second. But I'm not going to look at their balance sheet here. It's almost like it doesn't work here, okay? Cash flow overview. Mostly negative operating cash flow, okay? Mostly negative investing cash flow. That means they're buying stuff, making acquisitions. Let's see. Acquisition. So they had a tiny acquisition back in 2019, the last quarter of 2019. Then they had another tiny acquisition in the beginning of 2022. And then they had yet another much larger acquisition at the end of 2022. So that's probably potentially why the revenue jumped pretty significantly, or is part of the reason. Okay. So overall, they've acquired some other businesses. They're basically burning a lot of cash from operations. And, they had a big share issuance, but that's probably because of the SPAC is what I'm guessing. That's probably when they went public right here. Well, no, it said they went publicly traded. They were publicly traded first in the first quarter of 2021. That makes sense. And then they issued more shares here. Okay. And they have to. I mean, they have to issue shares. They have negative cash flow. I mean, that's what happens with every company. If you're not making cash, you need money from somewhere, obviously. Okay. So let's go look at the most recent earnings. This is the first quarter 2023 financial results, and these came out today. Okay. For the first quarter of 2023, the company reported revenue of $527 million and a net loss of $72 million. So their most recent profit margin was 527.8. Negative 13%. Negative 13% profit margin, which I believe is actually worse than they've normally been having. Let's go back and look at their normal net income. Okay, they've had a couple like massive bad quarters that were probably impairments or write-downs. 12% is on the high end of bad profit margins for this company, at least recently. Okay, so they're still unprofitable. Nothing has changed there. Insurance revenue grew by 14% to $317 million. And MCR, which stands for medical cost ratio, and we'll touch on that in a second, improved to 86.6% from 96.4%. As planned, non-insurance revenue declined by 65% to $205 million. So they plan to have non-insurance. Are they going all in on insurance revenue, it looks like? And MCR improved to 96. So this medical cost ratio, basically what they do is they take claims paid divided by premiums received, okay? And if you think about what that means, the lower the percentage, the more money or the more of the premiums that the company is keeping. Because all insurance is the insurance company collects a premium and in exchange takes some risks away from you. So what they want to do is get as much premium as possible and pay as few claims as possible. And this MCR ratio is what they use to calculate that. So they've had some improvement in medical claims ratio. That's good. Their insurance people or actuaries are geniuses, right? At least for the first quarter. And they have actually grown their insurance revenue. And I guess they have some kind of planned decline in other revenue, maybe contracts with the government. I don't know. But they said it was planned, but that still indicates a revenue decline. See, if we look at their reported revenue, $527 million for this most recent quarter, and we compare that to the prior year, let's go look. Revenue for the prior year for the first quarter was $874 million. So the massive growth rates that you're seeing, the revenue is basically collapsed, okay? A massive collapse of revenue. If you want the exact percentage, let's see. We got 527.8 minus, how much is revenue gone down? Revenue, my avenue, good sir. Minus 874.38 divided by 874.38. Their revenue has collapsed 40%. Keep that in mind, okay? But there are some good signs. The insurance revenue's up, and they're more profitable on the insurance side. So that's what I kind of get from the earnings there, okay? We're off to a fantastic start for blah, 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 blah. I am proud of our continued insurance revenue growth and significantly improved NCR. In addition, Clover Assistant continues to drive value across our entire organization. I'm pleased, based on the strong start, that we are already able to improve our full year 2023 guidance for both the insurance segment and consolidated health. So they raised guidance, okay? So here's some highlights. We can see total revenues down massively, which we already know. Insurance revenue is up. Non-insurance revenue just absolutely plunged. I guess I don't know what they're doing with that, being perfectly honest. But if you're seeing this company as a pure insurance company, I guess there's some good signs. I mean, it's improved. Salaries and benefits have basically stayed flat, which means they've become, if you think about it, their revenue went down, but their salaries and benefits stayed the same. Adjusted benefits, clownish. Okay. So not much to say here. Okay. I've already covered the very basics of this. Let's look at their full outlook. Insurance revenue is expected to be in the range of $1.18 billion to $1.23 billion in 2023, a growth rate of 9% to 13%. So insurance revenue will go up. The other revenue ain't doing too hot. Okay. So this is an insurance revenue play. Insurance MCR is expected to be in the range of 87 to 89%. So I would just compare that to the industry and say, is this better or worse than the average medical cost ratio for other health insurance companies? Non-insurance revenue is expected to be in the range of 0.75 billion to 0.8 billion. So let's see. Do they actually have total revenues? I don't have to add that together. They do not. Okay. So let's go ahead and add what they project their total revenue to be. Okay. So on the high end, their total revenue will be $2 billion. $2 billion of revenue is projected for 2023. How does that compare to the prior year? Okay. That's a pretty significant decline. So they had a massive explosion of revenue in 2022. But for 2023, now they're coming down to earth. Okay. So you're going to see massive revenue declines. Okay. But there's more to it than that. There's also the insurance part that's growing and the other revenues that they're, I guess, they don't care about anymore. Okay. Now, here's what annoys me about these earnings. They have the financial statements, but not really. So they have a very consolidated, abridged balance sheet. So we'd almost have to look at the 2022, December 31st, 2022, the 10K, excuse me, to actually see what the balance sheet looks like. Because right now, I mean, what is this? Okay. So what we have here is they show the change in cash. So cash went up. Okay, that doesn't really tell me anything. Cash could go up for a variety of reasons. Total assets have gone up very significantly. Okay, what did they do to increase total assets from 808 to $1.4 billion? What did they do? Unpaid claims is flat. Total liabilities also went up very significantly. So it looks like they potentially took on a lot of debt. That's what it seems like to me. And total stockholders' equity has gone down. So overall, they have destroyed shareholder value. In the course of 3 months, they have obliterated approximately $30.5 million of shareholder value. They have way more assets and they have more cash, but they also have even more liabilities, more debts. Okay. But it sucks because they don't have the freaking whatchamacallit. They don't have the full balance sheet, which hurts me. Like I can't do more research on it than that. Okay. So let's see. So this is just the income statement. I mean, obviously we've already talked about the revenue growth. Premium revenue, insurance revenue is up. Non-insurance is down. Other income, it's almost immaterial. It could be interest maybe, potentially, or some kind of, I'm not really sure, to be honest. It's immaterial. Net medical claims incurred. Okay, we already covered that. Salaries and benefits are flat. General and admin is flat. So the only thing that they've cut is medical claims incurred. Okay, but salaries and benefits, general and admin, that stayed the same. So if you're cutting in non-insurance revenue so much, why are your salaries and benefits and general and admin staying the same year over year? I mean, shouldn't you be cutting salaries and benefits, like cutting some employees? If you have this much of a decline in revenue, total revenue, which is a massive decline, what was it, like 40%? Why aren't you cutting salaries? Why aren't you getting rid of people, firing people, shutting down buildings, whatever? Okay. But overall, they're still operating at a loss. And we can see that shares outstanding have gone up a little bit. Okay. Let's see. Clover Health's reconciliation of non-GAAP fund and adjusted EBITDA. Okay, so they have stock-based compensation of 38. For stocks like this, I've seen worse stock-based compensation. Okay, 38 million of stock-based compensation on 527 million. I mean, that's not a crazy amount. I wish they had a statement of cash flows, man. That's so annoying. I want to know what they did something. Something big happened, okay? But it's kind of hard to fully cover this because they don't have the full balance sheet, okay? That's a massive pain in the butt. But they had, it looks like, some kind of acquisition, I'm thinking. They bought something. They acquired something because their assets went up massively, but their liabilities also went up massively. So they probably borrowed a bunch of money to buy another company is what I'm thinking. Let's go look at the most recent 10K. Okay, let's see if they give some indicators here. So, they have the business here. Let's see if they have the summarized risk factors. If not, we'll have to search for them. No. Okay, let's go to the risk factors. We have incurred net losses in the past when we may not be able to achieve or maintain profitability. We have limited experience with Clover Assistant. Our non-insurance business and continue to participate in Medicare fee-for-service, unique risk to our business. Let's see. So on February 22nd, 2022, CMS announced, among other things, that the DC model would be transitioned to a new model called ACO REACH model starting January. Our non-insurance business remains in relatively early stages of development. We are subject to the risk inherent to the launch of any new business. Whatever happened with their non-insurance business, it was an absolute catastrophe. I mean, we can read management's discussion and analysis, okay? But basically, you know, it's some of the standard risk factors. We're unprofitable. We've never made money. We could potentially never make money. Our MCR ratio could go up, blah, 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 blah. Okay. Let's go read management's discussion and analysis. Let's see what we got here, ladies and gentlemen. Okay. Operating segments. Our operations are through two reportable segments, insurance and non-insurance. Through our insurance segment, we provide PPO and HMO plans. Our non-insurance segment consists of our operations in connection with our participation in the DC model, which transitions to the ACO REACH model. What is the DC model? DC model insurance. What does that even mean? I hate when they have freaking stuff like this. And they're like, oh, we transitioned to the DC model. What does that mean? Okay, because whatever they did, it massively collapsed. I guess this transition hurt the company. All other clinical services, all corporate, are not included with corporate other. Let's see. Insurance segment, premiums earned. Our non-insurance in the direct contracting program. See, now they freaking say it. Okay, so the DC revenues are direct, so they have contracts, okay, which began in April 2020 and was transitioned to the ACO REACH model. As part of our non-insurance operations, we empower providers with Clover Assistant and offer a variety of programs aimed at reducing expenditures and preserving or enhancing the quality of care for non-insurance beneficiaries, okay? So basically, it looks like they're okay, this is just money they make, it looks like, from people that don't have insurance, okay? But overall, that part of their business, that's going to crap, okay? It looks like they're caring less about, they're focusing more on, you know, working with, you know, providing insurance or making money off of insurance and less off direct contracting. That's what that is, okay? So that whole part of their operation has massively collapsed. Now, let's go ahead and look at their balance sheet. Let's see. Well, actually, let's see if the auditor. Let's see what the auditor said. Where's the auditor? Ernst & Young. We have served as the company's auditor since 2018. Okay. Opinion on the financial statements. Let's see. In our opinion, the consolidated financial statements present fairly in all material specs. Okay, so the auditor said there's reasonable assurance that the financial statements are accurate. Okay. Let's look at internal controls. Let's see. We have audited internal controls. Let's see. In our opinion, the financial position we have audited based on the criteria, and our report expressed an unqualified opinion thereon. So that's good. Okay. So basically, the auditors are, you know, giving a clean bill of health. That doesn't mean there's not fraud, because auditors, they don't turn every leaf over. You have to understand that. But they're at least saying, based on what they've seen, and they've been pretty thorough, they're giving you reasonable assurance so you feel okay that the financial statements can be trusted, okay? So that's good, all right? I wonder if they had a going concern on here. They don't have that, okay. A lot of times you can identify a cloud stock if you type in going concern and search it. What that means is if you see a company, there's doubt about its ability to continue as a going concern. What that means is that the auditors think the company's probably going to go bankrupt, right? So let's look at the balance sheet, which is outdated. They didn't give me a freaking balance sheet. I'm sorry. I mean, hold on a minute. It's really annoying. It's like, why do they give you an abridged balance sheet? That's so stupid. Give us the whole balance sheet, you lazy scum. I mean, we can look at the most recent balance sheet, okay? Is there anything on here that jumps out? Investment securities available for sale. I mean, really, So they parked a lot of their money. So you can see their cash went down massively. It's because they parked a lot of money in available for sale investment security. So like basically bonds, stuff like that. Okay. Held to maturity, insignificant. Accrued retrospective premiums, other receivables, healthcare. Yeah, surety bonds and deposits. Yeah, there's really nothing crazy on the asset side. Let's see. Liabilities. Investment for securities available for sale. Amortized cost. That's interesting. Investment securities. Are these like, I wonder if these are, I wonder if they've taken deposits or they, why do they have investment securities on the liability side? That's it. I wonder if they have like, that's weird. I'm not sure why they have investment securities on the liability side of the balance sheet. Oh, wait, no, that's still, I'm like, oh, that doesn't make any sense. I was like, that doesn't make any sense. Okay, these are assets. I was like, what? Why are investments on the asset side? I'm still looking at assets. Excuse me, I screwed up. These are the current assets. These are the long-term assets. Excuse me. Sue me. Call a lawyer. Okay. Nothing really crazy here. I mean, they had a little acquisition. We saw that on the overview. Okay, now we're on liabilities. Excuse me. Let's see. Non-insurance payable. Let's see. Yeah, I don't really see anything crazy on here. I mean, at the end of the day, this company, it's unprofitable. So it's got to finance itself through either debt issuance or stock issuance. I mean, I can do a follow-up video when they actually release their freaking balance sheet because something big happened in this last quarter. I just can't see what it is. Okay. So overall, I mean, hopefully that's a decent enough analysis, buddy boy. You can email me if I miss anything. I don't mind, quickly going over the balance sheet. If you find it, email me once the new balance sheet comes out, and then I can look at the new balance sheet and see what happened. Because right now I can't see. They're not showing it, which is so stupid. Like, why would you have this? Like, where's that stupid thing they have? What is this? What is this? It's so stupid. But whatever. All right, let's do questions and let's close this out. Oh, by the way, this is a reminder. See, I just got paid to make this video. Okay, it's 22 minutes long. That's right where I wanted to be. I got paid to make it. If you want me to make a video for you, you click this link, you read it, you send me $40, and I'll make a video for you. I am waiting through the ads. You better, boy, get me paid. Clover, my Range Rover. You require the $40 on one. Are you joking with me? Dude, if you have to pay that in installments, don't pay me. You should focus on raising your income instead of giving me money. This guy. Oh man. Okay, I was like, what? I was like, it finally clicked with me. You're a wild man. You're gonna get me in trouble, dude. Will I turn into a leprechaun if I buy it? Yes, you will. You should go all in, dude. Doesn't diluting shares count as profit? Yeah, 100%. Just dilute, bro. Clover, please bend over. Who paid for this poop? LOL. Hey, you guys pay me? I produce, okay? Let's see. So what is being said is once you use or invest in Clover, it's over. Man, we got some good rhymes going on tonight. Daddy's in the house. What's up, Michael Garza? I got 99 abilities and an asset ain't one. Okay, guys. Once again, if you are seriously asking me, this guy posted this multiple times. If you want to pay me in installments, you should not be paying me, okay? Focus on your job. Put money in your savings account. Don't pay me if you cannot pay $40 and not be stressed about it, don't pay me, please, okay? I can live without the money. I might be in love with Vanguard cover call ETS. My mind is telling me no. My body's feeling yes. Oh, don't even start. Did you get rich from Baba stock? Not yet. I made my biggest ever gains in CLOV. Yeah, honestly, it's kind of a clown stock. I mean, it really is. This dumpster is worth cents now. It's you tell me what you think it's worth. Doesn't make any money. Tom Nash says Palantir's the next Tesla. Oh my God. Am I gonna have to roast Tom again? Bring back Kid Fresher, I'll make you eat tofu. If somebody pays me $400, I will bring back Hit Freshy. And if he becomes super psycho, I can ban him within a month, though. 400 smackers. You can start a GoFundMe. I like when girls stuff their panties with Clovers. Makes the snip nice and earthy. Are you stupid, Chris Belly? Yes. New Balance's new balance sheet is what daddy needs. Let's see. What are your top 10 stocks to buy for the Chinese invasion of Mongolia? I like Yurt Corp and Shenzhen Rocket Corp. Chinese stocks will only go down, bro. You shouldn't buy any Chinese stocks. Tattooed Chef is taking over the world. I can't wait for Tattooed Chef earnings. I hope somebody pays me for that. That would be awesome because I'm going to do it anyway. You might as well, just pay me. All right, guys, that's it. For the guy that paid me, let me know when the balance sheet comes out, and I'll do a quickie for you, okay? I owe you that much. But the most recent balance sheet has a lot of information that they're not showing. What protein shakes you on now? I don't drink protein shakes. Hello, Michelle. Why don't you get the hot Japanese girls on your ROTC? I'm not in ROTC, man. I was a battalion commander when I was in ROTC. Worst decision I ever made. Stupid. All right, guys, that's it. Pay me $40. Click this link, please. Just send me money. I need the money. I'm making bank. I'm getting so rich. So rich off of grifting you, okay? These other scammers, they charge like $100, $200, $5,000, $20,000. And here I am charging you $40. And that's it. What a kind, generous man I am to only charge you $40,000 and make you a $40, not $40,000, and make you a personal video. All right, that's it. I'm tired. You guys have a wonderful, delicious night. Cheers.